Why smart traders never short stocks even when it's tempting? There are plenty of reasons to short a stock: overvaluation, weak financials, insider selling, pump and dump signals. Shorting isn't without risk, but when done correctly, it can be a powerful tool. Investors are excited about the Microsoft Nebius $17 billion deal, but this could be a huge trap, at least in the short term. How did a company you may not have heard of become the talk of Wall Street's water coolers? And would their biggest risk be running out of caffeinated beverages? Picture this. Microsoft, the tech titan, agrees to pour $17.4 billion into Nebius, ostensibly to accelerate AI infrastructure build-out, get priority on Nebius's bleeding-edge cloud services, and possibly to ensure Nebius developers never see the sun again. Now let's look beyond the hype. What is Nebius, and why does Microsoft want a piece of it? Nebius did not start as a cloud-native AI infrastructure company. It was actually part of a Russian company, Yandex. After a sale of Russian operations, the parent company renamed itself Nebius Group and started focusing on AI cloud infrastructure. Over the past 3 years, Nebius grew rapidly via aggressive R&D focusing on proprietary interconnects and AI-optimized storage. They gained partnerships by serving as the infrastructure backbone for several high-profile AI unicorns. Nebius shattered revenues in 2024, posting a Q1 2025 year-on-year growth rate of over 300%. Now, Microsoft, already one of the world's largest cloud provider, do they need Nebius? And more importantly, what's in it for them? What is Microsoft's logic? Maybe to diversify bets or some strategic partnerships to help mitigate supply chain disruptions by securing priority access via this deal, Microsoft ties up valuable Nebius resources for its own platforms, starving out competitors at least for now. Or maybe this is the beginning of a joint R&D collaborative roadmap for AI, storage, and network innovations. But with great power comes a truly staggering list of legal clauses. And what if there is a non-compete restriction? This may alienate other cloud players. Now, there are plenty of risks. For example, supply chain, energy costs, hardware obsolescence, competition, regulation, the AI infrastructure markets. Growth is breathtaking, but history suggests every gold rush creates more broken shovels than billionaires. Established hyperscalers have both scale and customer lock-in. With that stage set, let's zoom in on what everyone actually wants to know. Is this deal genius or madness? And more importantly, how can you make or lose money? Now, here are the pros, cons, and the contrarian play, aka, should you short Nebius on paper, or at least on the tear-stained spreadsheets of Nebius's finance team? The deal looks great. Some of the major pros are: number one, capital injection. $17.4 billion gives Nebius expansion ammo to build higher and innovate at warp speed. Number two, technical validation with Microsoft's stamp of approval. This may turn Nebius into one of the company you have to use if you want serious AI muscle. Number three, synergy and speed. A joint R&D means Nebius's innovations are less likely to get lost in translation or in Microsoft team meeting. Number four is my favorite question. Can they build a moat? By inking exclusivity, Nebius locks in future revenue and keeps rivals at arm's length. Now pay attention to the shareholder euphoria. The news sent Nebius's stock up over 50% in trading, generating impressive short-term paper gains and memes in an industry plagued by high capex. In brutal competition, Nebius just got both a war chest and a high-profile client. The Microsoft effect also means more customers and partners may move to Nebius now that its survival and growth prospects look so much stronger. The PR win alone could be worth billions in future contracts. If you thought the pros were compelling, wait until you hear the cons. Seriously, do not adjust your volume. We haven't dropped the mic yet. Now, here are some key disadvantages. Number one, concentration risk. Nebius is now beholden to a single mega customer. If Microsoft sneezes, Nebius catches the flu. Valuation surge equals bubble risk. Nebius's market cap exploded far faster than fundamentals justify echoes of Zoom, Peloton, or your cousin's NFT portfolio. Now let's take a look at the innovation bottleneck. With Microsoft pulling the strings, Nebius might pivot to serving just one master, stifling its creative edge. Another problem can be customer alienation. Non-Microsoft partners may flee, fearing Microsoft lock-in or spying anyone. Remember Skype? Just me? I'm just saying. And as stated earlier, there's also a risk of regulatory scrutiny. Exclusive deals in critical infrastructure draw government attention. And finally, we have an execution risk. Deploying $17.4 billion without embarrassing cost overruns or technical blunders is challenging for any company, let alone a relative newcomer. Now, is this a short squeeze or a train wreck? Are you the contrarian the market needs or deserves? Let's feed your curiosity. Should you short Nebius into this euphoric momentum? Here's the case. Number one, market overreaction. The deal triggered a stampede not seen since Black Friday sales on giant TVs. Nebius shares rocketed over 50% on deal news, lifting the company's price-to-sales ratio above historic norms for infrastructure firms. AI infrastructure is the new .com, and every gold rush ends the same way. Someone selling shovels, the rest holding empty bags. Now let's look at the valuation versus the fundamentals. Nebius's valuation now dwarfs competitors with similar revenue and growth, largely due to speculative hype. In no way, shape, or form is this a bad company. Recent quarters showed margin expansion even before the Microsoft windfall hit operational complexity. But here's another issue: execution complexity. Delivering on massive, staggered investments is notoriously hard. Integration risk is high. Every AI partnership announcement comes with a subtext: we reserve the right to blame each other when things go south, which they do eventually. Even bullish analysts admit that Nebius's valuation now implies record-setting execution and market share retention forever. The problem is, history shows few tech companies deliver on sky-high projections for more than a couple years. For example, WeWork, Blockbuster, Segway with Nebius. The risk-adjusted returns are starting to look dicey. Shorting Nebius isn't betting on failure. It's betting that fundamentals eventually matter more than hype. Consider hedging or option strategies to neutralize some risk in this frothy market, but don't ignore the warning signs. Let's lay out the battleground. Should you ride the hype or wait for the next shoe to drop? Well, what's your investment horizon? If it's short-term, let's say 6 to 12 months, there are some potential opportunities, which are volatility plays, a possible upside if euphoria lasts, or maybe options arbitrage. But make sure to follow the news on trading activity. Watch out for sudden market reversals and news-driven downdrafts. Now, for long-term investors, here are your potential opportunities. Let's say the AI market growth lifts all boats. If Nebius executes and retains non-Microsoft clients, this could be huge. But still, there's an execution risk, regulatory risk, sector rotation, or even hardware commoditization. But with no doubt in mind, the short-term investor should be able to profit from volatility and momentum. The long-term investor must believe that Nebius can retain relevance once the Microsoft hype fades. Otherwise, prepare for disappointment and clever explanations to your spouse about those losses. If Nebius becomes a critical note in the AI infrastructure web, the valuation could be justified eventually. But even here, risks loom. Hardware refresh cycles, rising energy costs, and the risk of Microsoft doing it themselves all crimp Nebius's long-haul story. Plus, customers terrified of Microsoft lock in May prove hard to win back. Here's the payoff you've waited 20 minutes for. The biggest risk no one's discussing is not technical, regulatory, or even financial. It's psychological. The Nebius-Microsoft deal is now a consensus play. Everyone believes it's the next sure thing. That's when the market is most exposed to shocks like an earnings miss, a failed deployment, or the whisper of government concern. Remember, crowded trades make for the weakest hands, and the fastest price reversals want real value. Watch for the turning of sentiment when consensus feels unbreakable. Contrarians feast.